It's just not worth it any longer to park a tremendous amount of your savings in US dollars and US debt. That's a fact. And it's only going to get worse over time. The 490 stocks in the S&P 500 haven't grown their earnings at all in the last couple of years. It's just those 10 stocks. Those 10 stocks have the highest concentration of ownership ever. When the plug is pulled, there will be a very narrow exit door. So you have to identify it ahead of time and get out.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for August 11th through August 18th, 2025, while supplies last. First this week, 1 ounce assorted silver rounds are just $1.49 over spot per ounce. Next, 10-ounce silver Pamp Bars are just $2.99 over spot per ounce. 90% silver assorted US half dollars are just 99 cents over spot per ounce. MS64 gold US Saint Gauden $20 coins are just $180 over melt per coin. 1 ounce gold Rand Refinery bars are only $65 over spot per ounce. And finally, 1 10th-ounce platinum UK Britannia are just $34 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. Thank you all for joining us here. We have a guest that you will recognize. Michael Pento is an active money manager at Pento Portfolio Strategies. He's joining us this Thursday, August 14th, 2025. Michael, thank you for coming back on Liberty and Finance.
Always my pleasure, Mr. Kaiser.
It feels to me like it's been way longer than usual, maybe because the wheels keep spinning faster and faster in many aspects of our lives. Certainly it's true in our financial lives that there's a fire hose of executive orders and actions going on all around the world, geopolitically, financially, monetarily. If we could get your latest thoughts on the main leading indicators that you're watching and what they're telling you about what's happening right now and what we're heading into. I guess probably unavoidable in this discussion will be the perhaps changes at the Fed and changes in interest rates and changes in tariffs. We're going to have to probably hit some of those because they could be potentially very impactful to what's going on for the next few quarters. But you'll tell us what you're watching.
Well, I've been predicting for years that the U.S. would end up being a banana republic. Actually, I think it's now decades I predicted this. And as I said recently in a commentary, we're no longer predicting that. We're just saying it's here. It's here. You got the $37 trillion in debt, $3 billion in interest payments every day. The debt is up $14 trillion since 2020. This is insanity beyond belief. The deficit for July was $291 billion. That's the second largest deficit for the month of July in U.S. history. Now, this is happening in the context of pretty much full employment, we're told, and a healthy economy, ex recession. So we're a banana republic. Not only that, but some developments I've seen lately with the administration, who, by the way, I always say this because people will accuse me of being anti-Trump. I did vote for the man, and I think he's infinitely better than Kamala Harris would ever have been on her best day. But I'm sure I'll offend everybody when I say I don't like what he's doing with the Bureau of Labor Statistics or with the Federal Reserve. There's some significant trenchant problems with both those institutions. But it's the opposite of what the president is railing against. So, for instance, the BLS persistently overestimates the number of initial jobs numbers. And they underestimate initial claims perpetually. And then they go back ex post and revise them much lower. So if you wanted to damage the administration, what you would do is when everybody's myopically focused on the first Friday of every month, they would put out a really bad number and revise them higher. Listen, I'm apolitical. I just want to make money for my clients. I'm just trying to be honest here. So I'm not a political hack. So when the president does something good, I'll support him, and he does something egregious, I'm going to call him out on it. Likewise, he's railing against Jerome Powell, and the salient issue there is that he's not cutting interest rates fast enough. But the problem with the Federal Reserve isn't that it's perpetually over supplying the public with a positive real interest rate. The problem with the Federal Reserve is that it's chronically produced negative real interest rates. And for the last 20 years, most of that time, it's been a nominal rate that's been close to zero. And real rates profoundly negative. So if you want to pick a fight with the Federal Reserve, I'm in the vanguard. If you want to pick a fight with the BLS, I'm in the vanguard. Totally needs to revamp, but for the opposite reasons of what the president's saying. So, when you think about Banana Republic, you think about Banana Republic, you can't trust the data, the country is bankrupt, and the central bank works at the behest of, is a sycophant of the administration. So this is where we're headed. And you asked me, I am asking, I'm going to answer your question in a very long, so thank you for giving me a little more rope. But I want to make sure the viewers get what they're paying for here. Their money, get their money's worth. I'm still long the market. I'm net long. I am not net short. We've got precious metals, and we've got some foreign stocks. We've got defensive stocks. We're long the market, participating in this bubble, but the bubble is absolutely ready to crack. And I can quickly give you two reasons why I think the fantasy is almost over and reality is going to hit. So I will give you these two reasons. Number one, the labor market is fracturing and the economy is weakening. That is undebatable. Everybody understands this. This is not under any kind of, this is something objectively true. So if this continues, and I have every reason to believe that it will, what if the Federal Reserve is not going to cut rates significantly in the manner that is needed to support an eroding economy, an eroding earnings per share, and woefully disappoints Wall Street just because Powell just cannot cut interest rates when you get inflation numbers like we did today on the producer price index, leaping way over 3%. So that would cause the market to sell off. But I think a more likely scenario is we do get significant rate cuts, either by Jerome Powell or whoever he or she is that's going to replace him, an obsequious sycophant, as I like to say. That's a May 2026 story. And when they cut interest rates, the same function will happen as what occurred in 2024. So the Fed cuts the Fed funds rate. That's the rate that's applied to money markets, and long-term rates spike. Exactly what happened in 2024. In that case, in this case, if the Fed is going to cut rates aggressively, when inflation is waxing further away from 2% and really crushing the middle class even further, the bond market, investors might lose all confidence in the bond market. And then you have spiking rates on auto loans, student loans, corporate debt, and mortgages. So that would cause the market to crash even faster and further.
These two major options, neither one sounds promising for the outcomes on the ordinary people. It sounds like there's two different timelines here. One would be the timeline for the next year, and then the other would be the timeline after a Jerome Powell replacement with a new candidate who would do the administration's bidding of aggressively cutting rates. Given that dual timeline, do you see this being a two-step process where we had one direction, then we had the other direction?
It's a great question. So, listen, making this kind of prediction is a fool's errand, but we don't have to do that because of the model that I created. So I'll understand when credit markets are fracturing. I'll understand when the money markets are faltering. I'll look at credit spreads. I'll look at financial conditions, and it's not going to be something that's going to go, beyond my watch. But the most likely issue I see is that you could see this scenario play out. The Fed only cuts interest rates on the margin because Powell's fettered by inflation reports that really haven't even priced in the tariffs yet. So most of these, we had a very bad inflation report for the CPI, and then we had even a worse one for producer prices, just came out this week. But if you look into those two reports, they were services prices that were going higher. They were not things related to tariffs yet. The tariffs have yet to hit. That's going to be reported, in September and in October. So what if we see the market start to falter then, and that's a very seasonally appropriate period for it to happen anyway, simply because the market is anticipating rate cuts that just can't happen, and you get a sell-off. Then you might get a little bit of a reprieve until April, May of 2026, and then you do get your significant rate cuts, and then the long end of the bond market goes ballistic. That would be the more significant and more trenchant of the sell-offs. But we are so overdue. I mean, I just I cannot imagine this can go on much longer. And I'm saying this from someone who manages money, who reports his returns every month, and is verifiably long the market. But I without this model that I created, I wouldn't be able to sleep well. I want to know when those handful of oligarchs and autocrats that actually run this planet, and their minions and their cohorts, when they understand when this thing's going to crash, they start acting on it ahead of time before anybody else knows. But my model picks up on those arcane components. I'll see their footsteps and I'll go along with them. I'll do it legally, though, not illegally.
We won't have to have the Pento dossier to talk about. You mentioned faltering appetite for the U.S. Treasury bonds in a market where the holders or potential buyers of those bonds recognize that the Fed has lost control. Do you see that this is already happening internationally with the BRICS plus nations pivoting away from holdings of the Treasury, and China being net sellers, others being net sellers, that were primary supporters of the U.S. Treasury auctions in the past?
Well, it's already happened. That's not a prediction. That's a fact. So if you're a foreign holder of U.S. debt, and then all of a sudden you're capriciously subject to sanctions and tariffs and confiscations, well, you know that's happened before. So you're very cautious right now. But another dynamic that's happening is that since we're seeing this chaos in the tariffs front, then if you have the idea that all of a sudden your tariffs go from a level of 2% to 16% on average, and in some countries they're arbitrarily and capriciously raised to 50% like India because you're buying Russian oil, you start thinking to yourself, wait a second, I'm going to have a much lower amount of trade surplus that I need to recycle into the U.S. bond market. So that's another dynamic that's happening. So the final nail in the coffin, though, is going to be the insolvency and inflation of the United States. We're headed, like I said, it's Banana Republic. I think we've arrived. And you're just not going to be willing to park your money in a 10-year Treasury note. If you could buy a Japanese note in your, if you're a Japanese citizen and you can get 3% on a 30-year, 40-year bond, and you don't have to worry about currency fluctuations, well, then you just go and buy your own domestic debt. That's an option that Japanese haven't had for a long time. And that's the case in a lot of parts of the world too, Dunnigan. It's just not worth it any longer to park a tremendous amount of your savings in US dollars and US debt. That's a fact. And it's only going to get worse over time.
That certainly holds true, it seems, in the scenario that's playing out for traditional foreign holders of U.S. bonds, and based on the need for dollars, based on the world reserve currency status and the recycling, the whole Triffin's dilemma problem that forces the United States to maintain a negative balance of trade in order to supply the world with all the dollars, et cetera. But what about this new kid on the block, stable coins that are on the horizon that supposedly can be generate synthetic demand for U.S. Treasuries from retail buyers who might otherwise have no interest in those, but they certainly are potentially going to be interested in that new form that may be coming. Any thoughts from you on that?
Yeah, I mean, I have only one major thought there. The whole cachet behind cryptocurrencies, or at least one of the major cachets, it's protection against the dollar, right?
Well, against centralized control, centralized monitoring, centralized government.
I can have my transactions are not anonymous, they're immutable, and they're decentralized. None of those things are the case when you have the cryptocurrency tied to the US dollar and to the US Treasury complex. Everybody knows who you are, they know that you own it, and they're tied to the dollar, I thought these things were supposed to be rare and the protection against a falling dollar. So it's completely antithetical to every, supposed reason for these cryptocurrencies to have value in the first place. So that's my thought. I mean, if you're going to own a cryptocurrency, why would you tie it to the dollar and to a treasury bond? It doesn't. I think the demand for these assets is way overblown. It's going to underwhelm you significantly. I manage lots of money and I have lots of friends in the business. I don't know anybody who's interested in this, really. It's a very arcane, small demand, and it's not going to give a lot of supply to treasuries. I don't think so at all.
You mentioned earlier on you are net long the market and also have some precious metals. Can you talk to our audience who are keenly interested in the role that precious metals currently should be playing in their portfolio as to how you see it currently in your portfolio?
So I'm about 4.5% in platinum and 4.5% in gold. And I'm looking to increase that, but not at this moment. Listen, the bull market in gold is not exactly something that's a secret. It's outperformed the S&P 500 for the last 25 years. So it is a very long and protracted bull market. And the reason why I own 5% of it and not less, you have to have some. And I'm talking about liquid paper gold. I'm not talking about, I've always recommend you get 5% physical gold in your possession. You start there. And that's something that's an heirloom for your progeny. But if you want to talk about liquid paper gold, it's right now 5% because we have an insolvent nation with a currency that's weakening. And not only weakening against other flawed fiat currencies, but weakening against hard assets. I expect that to increase in a dramatic fashion next year. The only thing that gives me a little reticency about this is if I said before, if the long end of the bond market really becomes intractable and rates begin to spike, it is going to hurt gold as well. Not as much as it's going to hurt Bitcoin, and not as much as it's going to hurt the S&P 500 and the major league tech. I mean, that's where the big bubble is in that Mag 7. That's where everybody is sequestered, and the Apple, the Google, the Amazon, and because they're market cap weighted index, you have passive funds just flowing into those stocks, and they become so. If the 490 stocks in the S&P 500 haven't grown their earnings at all in the last couple of years, it's just those 10 stocks, and those 10 stocks have the highest concentration of ownership ever in relations with the other 490. So you have a massive bubble that when the plug is pulled, there will be a very narrow exit door. So you have to identify it ahead of time and get out. And as I said, this is a Thursday evening recording. This is not the case right now. I'm not out of the market. But if you wanted to try and get, and I'm not gonna guess today and hold myself to it, because I'm working every day. I don't have to hold myself to some kind of commitment to sell and set at the start of September. But an appropriate time frame, given the seasonality, and given what's happening in the next few inflation reports, according to my predictions, that inflation is going to run hot, both on PPI and CPI, and the fact that I believe the Fed is not going to cut rates by 50 basis points. You had Treasury Secretary Besson come on the other day and call for, and he did say it, I know he tried to walk the comments back today, but he wanted a 50 basis point rate cut immediately and 150 to 175 basis points in cuts in total. in a rather short duration. You'll wreck the dollar and you'll wreck the bond market, and then and I believe if you do that, it's all over for stocks, and you better be on the vanguard, monitoring those systems very closely, because you're gonna short circuit your retirement if you don't.
There have been proposals. Dr. Judy Shelton, who was part of Trump's first administration, had recommended a 50-year long bond redeemable in gold at maturity with perhaps even a zero coupon to try to tie down the long end of the curve. Any thoughts from you on the viability of a concept like that and how you think that would affect appetite for long U.S. treasuries?
Well, I wish they would have thought of that in 2020 when long-term treasuries were the benchmark was yielding 0.33%. That would have been a good thing for us to do. Listen, I would love to tie treasuries. I would love to tie the dollar back to gold. That would be wonderful. It's just never going to happen. The U.S. doesn't have the gold. The administration, I've never seen the administration really praise or at least extol the virtues of tying the dollar to precious metals. So it's all about Bitcoin. So it's just, Judy Shelton, God bless her, but good luck. I don't think it's going to happen. I wish it did, but it's probably not going to happen.
Where do you see analogs to the current situation, if there are any? They say history doesn't repeat, but it rhymes. Are there lessons that you are drawing on from past markets that have been setups like we're seeing now that lead you to have more confidence on the direction that this ship is going to sail or sink going forward?
Well, there's the way I see it real quickly, because I know we're running out of time, but there's two outcomes, and they're both very bad. We're either Japan 1989, where you have a deflationary bust and asset prices crash, and they still haven't come back to where they were 35 years ago, 35 years later. So that 36 years now. And by the way, Japan's GDP growth in dollar terms is lower today than it was in 1989. No growth. So that's one possible outcome. And that's the better of the two outcomes. And the other outcome is Weimar Germany, Hungarian Pengo, Zimbabwe. That's the other possibility. Or Rome. Just Rome was. You can't. Well, okay. Was Rome a banana republic? No. Did Rome have the world's reserve currency? Yes. Did Rome have 1,000% inflation in the dinar? Yes, it did. So don't tell me the dollar can't crash, and don't tell me the interest rates can't spike. I hear some people, very smart people, who wrote some books about the collapse of leading up to the global financial crisis, saying, "Oi, the deficit." I think this person says, "Oi, the deficit." Oi, the deficit. Well, because he says that the dollar's strong and there's no alternative to owning the most liquid market on the planet. Okay, that's wonderful. But didn't the 10-year note yield go to 15% in 1980, in 1981? And where is it today? 4.5. So good, we have the world's reserve currency, and we have the most deepest and liquid bond market, but that doesn't mean interest rates can't spike to 15%. And the conditions today are much worse than they were in the late 70s or early 80s. The debt to GDP back then was like 35%. And now we're 123%. We didn't have $2 trillion deficits, 6% of GDP back then.
Yeah, and tacking on another $1 trillion every 157 days or something like that, or less.
$3 billion in interest payments every day.
Michael, if you've mentioned several times throughout this that people will be well served to have a forward view, have someone watching leading indicators for them, so they know when to not be in the crushing masses trying to squeeze out the door of the casino and getting trampled. How can people take advantage of your services if they want that kind of an active money manager?
Well, there's two levels. One is $50 a year. You can get my midweek reality check, and I'll give you some broader signals as to what's happening every week, every Wednesday. It's called a midweek reality check. But if you have $100,000 and you're a U.S. citizen and you qualify for a portfolio, I'll manage your money directly in that 20-point algorithm called the inflation, deflation, and economic cycle model. So I'll make sure you only know about it, you'll know about it before anybody else, and I'll tell you exactly what to own because I'll do it for you. I will protect you. And I'm looking at things like the copper-gold ratio, financial conditions index, credit spreads, all these arcane things that most people don't look at, or if they look at, they don't know how to read them. Because let's face it, most people most people who do what I do are salespeople. They're just, they'll take your age and they'll put 50% in stocks and 50% in bonds and go off to the golf course and try to, raise some money. I don't do that. I'm an economist and market strategist. So that's what I'll do.
We've been speaking.
And the website is pentoport.com if you're so interested.
There you go. Michael Pento, active money manager, the founder of Pento Portfolio Strategies at pentoport.com. Michael, thank you for joining us again on Liberty and Finance.
Always a pleasure.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for August 11th through August 18th, 2025, while supplies last. First this week, 1 ounce assorted silver rounds are just $1.49 over spot per ounce. Next, 10 ounce silver Pamp Bars are just $2.99 over spot per ounce. 90% silver assorted US half dollars are just 99 cents over spot per ounce. MS64 gold US Saint Gauden $20 coins are just $180 over melt per coin. 1 ounce gold Rand Refinery bars are only $65 over spot per ounce. And finally, 1/10 ounce platinum UK Britannia are just $34 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.